first 5 years of the Embark story was to create the foundation stones of a business which was able to participate in the robo-advice sector, the IFA market, retail banking and workplace savings. To do that, we needed strength across wrap platform, across bespoke pensions, across flexible benefits, and the research and consulting capabilities that empower connectivity between those variables. I'm delighted to say that after 5 years, we have a strong position in each. In the SaaS market, we are clearly the #1 in the UK, with a size which is a factor of 2 over our nearest competitor. In the bespoke SIPP market, we sit inside the top 5 in a breakaway group of competitors who control roughly 90% of SIPP flows in the UK. In the wrap platform space, we're only in the top 20, but we were new entrants very late into 2017. But already in our roster of signed distribution partners, I see us hitting a growth rate in 2018 and 2019, which is significantly ahead of our competition in that space. First and foremost is the revenue growth that we've seen in the business this year. So we're up 59% year over year, with a run rate revenue for the year in total of £29.2 million, which is a phenomenal result for a small SME enterprise like ourselves. That's driven predominantly by new client numbers, which are up 31% to an all-time high of 114,000 consumers, spread across the full product breadth of the Embark Group, from our complex pension offerings right the way through to our junior ISA products. Assets under management naturally follow client growth as revenue follows assets. So our AUM again peaked at 11.5 billion, following the sale of 0.3 billion of assets to a new partner, Mazars, at the end of the year. This signifies a 42% increase in our overall AUA for the group year on year. So 3 statistics which really paint a picture of transformational change for the group over that 12-month period. Controlled inorganic expansion, but also strong organic results, which is the real lifeblood of a very successful company. As our CFO, Vincent Camine, will come on to tell you in a little bit more detail, acquiring businesses which add scale, economic advantage, product reach and market positioning is the hallmark of how we've played in the M&A market. And after 5 years, including 8 transactions on the inbound side of M&A and 1 on the outside, we're now in a position where we have a solid foundation stone for the phase 2 of the Embark Group story.
The first one was the acquisition of the activity of Discuss, the DFM research engine, that was completed in March. The second transaction was the acquisition of the shares of EBS Management PLC from Charles Stanley at the end of May, which was a significant contribution to the activity and the assets of the group. And the third one was actually a combination of transactions with Mazars, the first one being the divestment of the financial planning activity that we sold to Mazars, and we joined forces then on the employee benefit front by creating a company that was renamed Vested Employee Benefits Limited. The other thing that is important long term is the proportion of recurring revenue within our financials. That proportion actually, despite the transaction that we completed, remained very stable and very high at around 80%. If we now look at operating expenses, they also increased significantly during the year by around 54% at 33 million. But that increase in expenses is actually the result of opposite trends, and I'm just going to detail them fairly quickly. So similar to revenues, the increase is largely driven by the contribution and the impact of the transaction that we completed in both 2016 and 2017. As an example, staff costs, which are the #1 cost category, increased by almost 85% at 22 million during the year, and reflecting the increase in average staff from around 350 to around 490. The level of investment last year was over 3 million. The lion's share of those investments obviously relate to the platform. We created and launched the new shared services center, so Embark Corporate Services, and we transferred all the support function to that entity. The cash balance ended the year at 3.9 million versus 2.5 the year before. So this is a major improvement, obviously benefited from the proceeds of the sale of the financial planning activity. Net assets rose 33% year on year at 7.9 million. So this is also a key component of financial strength. During the year, all our pension businesses got upgraded to a B strong rating. So again, that's a major testimony of the financial strength of the company.
We are looking to build strategically a very diverse shop, whether it be from a distribution perspective, from an underlying product and service perspective, or from a source of revenue. The central planks are very simple, however. We are a pension-centric business, we are a technology and digitally centric business, and we are an annuitized revenue-centric business. They are the things which will drive growth over a 5, 10, 15-year period and retain us as a solid investment for our shareholders, and a great place to be for those who want an exciting career in any of that space.